David Bacher, we're back for a month that I think most people want to forget in the investment markets.
Certainly. At Corion this morning, we were actually discussing the things that people had to or fund manager had to contend with during the month. You think about the heightened geopolitical risks, the lockdown, supply chain disruptions, the Fed being behind the eight ball, and that's just overseas. Locally, the floods in KwaZulu-Natal, Eskom. It was really a difficult month, and I think most fund managers will look back at April 2022 as one of their hardest in their career.
Yeah, try and forget it. When you go back to your report that you bring out every month, I was intrigued to see that for the S&P 500 index, the broad-based index in America, it was the worst start to a year since 1939. That seems almost impossible.
Correct. I think that in itself is quite amazing. But if you take that and you add what happened to the bond market, now the bond market generally diversifies returns and acts as a counterbalance offered to equity markets. The bond market sold off almost 6%, and that is the worst depreciation of the bond market on record. So you have portfolios that are looking for diversification, that have a balance of bonds and equities, really suffering. So it was quite a unique situation.
I was reading in the Wall Street Journal this morning exactly that point, that usually if equities or shares go down, then you can balance it off by being in bonds. But this is unusual in that for 2022, you've had both shares and bonds falling out of bed. Pretty much everything at the moment is under pressure.
Correct. So the worst fear for a person investing in bonds is inflation. So as inflation kicked up and you realize the Fed was going to aggressively hike interest rates, that was the main reason why bonds sold off so much, which is also quite unusual. When equity sell off, is usually fear of growth, fear of recession, and bond markets generally act as a protection and do well in those environments. But in this particular case, you had the inflation fear dominating the recession fear, and that was why equities and bonds got hit at the same time.
I thought after February, which was a really bad month, and then we had a good bounce back in March, that perhaps things were starting to stabilize. But how are money managers seeing it? Did they use March as a way to protect themselves against another February, another sell-off, which we saw coming in April?
Well, the old investment adage, sell in May and go away, I think you can throw that out the window. Maybe it's a bit late. Maybe it's buy in May and the returns will pay. I mean, that's how much shares. And
well done, David. Did you just think that up now?
I have to give a credit to a colleague of mine who wrote that in one of his articles. I'm not that original, but it stuck with me and it resonated with me because it is so pertinent. When you have shares coming off so quickly, you always got to think what opportunities present. Volatility is very hard to endure, very hard to live with, but it often is an opportunity to invest at right prices. And what we've been saying on the show is, we take a long-term view at Corion. You look at valuations. The valuations were high, in our opinion, high levels, signaling expensive times to buy shares. Those valuations are coming more to normalized levels. So certainly from our side, we've actually been increasing exposure to risk assets during this period. And I think a lot of managers who take a long-term view would be doing the same.
At the Berkshire Hathaway AGM over the weekend, Warren Buffett told us that he'd spent $40 billion or invested $40 billion, about a third of his ammo in the past quarter. And he's been whining for years, literally, that things were too expensive. So if he thinks there's value, I guess what you're saying now is others should be thinking the same way too.
Correct. I mean, I think we share similar investment approaches, thinking over the long term and embracing volatility. I say it with humility because I am comparing just that element to one of the greatest investors of all time. But at the same time, he has been buying, but he's also been pointing out the same kind of rhetoric on the weekend was, there has been a bit of a gambling mindset of investors, and also issued a bit of a caution out there. So, Warren Buffett has 4 or 5 stocks where he spent that 60 billion rand in, where he takes a very long-term view, and when that price comes off, he's a buyer, and that I think is a lesson for all investors.
So how are fund managers in South Africa describing the month of April?
I think as I said earlier, it's not a month that they can look back with fondly. I think certain managers got hit more than others. I listened to a podcast by William Green, the famous journalist, and I think he described the two investment styles, value and growth, quite aptly, where he said, value is more about protecting where your bias is, while growth managers is more about projecting earnings, projecting how companies can grow, using discount rates that were priced in at lower rates. And those growth kind of projecting value styles, where you had a lot of exposure to NASDAQ, to tech stocks, to stocks that were at higher valuations, got particularly hard hit in this month. So those managers, the managers that follow a momentum growth strategy, I think really had a particularly tough month.
I'm not sure what your views are on Cathy Wood from the ARC funds, but she seems to have people who absolutely love her or absolutely hate her. But reading through her research material, she said that it's the greatest buying opportunity that she's seen for a long time, and that the disruptive, innovative companies are still disrupting and still innovating and still growing rapidly, yet their prices are now a fraction of what they were before. You take that with a pinch of salt?
Look, I wouldn't like to point fingers at other fund managers. Investing is a difficult game. I would have preferred she said that a year ago when she was, trying to get investors and promoting her firm at much higher valuations. So yes, I agree with the long-term thesis that you want to be in companies that are disruptive, that are growing earnings, that have a competitive advantage. But it's always at what price you pay for those earnings. And at the valuations of a year ago, it was, in our opinion, ludicrous to invest in some of those companies. Now, different story. I think she has a point.
I suppose it's a bit like Amazon buying that after the January 2000 crash, after it lost 98%. Even if you'd held it at the peak, bought it at the peak in 99, you'd have still got a 10-bagger in time to come. So you pays your money and takes your chances, but when the opportunity exists, as you're suggesting now, about May could be your big payday.
Correct.
What asset classes outside of high tech and the disruptive companies were hardest hit in this period?
I think Bitcoin, so when you have an environment of heightened risk, a sell-off, your riskier assets generally come off the most, and that's what we saw. So almost in order, you had Bitcoin down, I think Bitcoin was down 17%, NASDAQ was down pretty similar, about 16, and then the S&P was down about 8. So the higher risk, the higher speculative your instrument, you would have had probably the largest drawdown.
What funds did well? And I'm going to ask this under advisement because looking at your inflows and outflows that you report that you produce in your report, it looked like Alan Gray had a pretty tough period for outflows. But on the other end, did anybody benefit here?
Well, touching on Alan Gray, Alan Gray are a great investment manager, and while the report tries to highlight things in a very succinct way, sometimes it misses out the detail, and that's the cost of getting a report in such a small size. But Alan Gray is the biggest investment manager. So when people are just investing, just the law of numbers, you will see the biggest outflows from the biggest manager. And that counts against them. So you've got to take it in the context.
But hundreds of millions of rands going out of their flagship funds, that's a bad month.
It is a bad month. But when you're managing billions and billions, is all in perspective. So I don't want to be too critical on Alan Gray. The recent performance has been good. But what funds did well last month? Very few, because it was a sell-off across the board. But I think in the context of which asset classes you wanted to be, it was really only one asset class that did well, and that was the US dollar. That was, I also read a piece by, I think it was Deutsche Bank, where they track 18 different asset classes. And out of those 18 asset classes, 17 were down. The only one that wasn't down was the US dollar.
Strange when inflation is going through the roof, but I guess the war in Ukraine probably had something to do with that. There's so many moving parts, though, now in investing. What do you suggest? What do you guys at Corion, how are you restructuring?
Well, I think the contrarian in us is starting to look a bit further, maybe 12 months out. Inflation has been a big issue, but you must also remember inflation works on a base effect. So once your prices are at these elevated levels, next year, if oil drops down, you could have a deflationary contribution to your numbers. So we're starting to think that maybe all the inflation is already priced into the market. The biggest change in our clients' portfolios at Corion over the last month is for the first time in many, many years, we've been buying global bonds. And that I didn't think was possible at the beginning of the year, but because of the sell-off in global bonds, global bonds do traditionally act as a hedge against a recession. There is definitely an increase in chance of recession. So although we're not overweight global bonds, I think a more balanced portfolio is necessary, and the odds of needing more protection assets in your portfolio is increasing. So that was probably the biggest change in our portfolios.
Help me out here. Bonds at the moment are yielding less than inflation. Why would they be an appealing investment?
So, as I said, we're not overweight bonds, but we used to hold zero. And to have zero bonds in a portfolio is quite a big call. So I'm just saying we've narrowed that down. But I think the main reason to answer that question is traditionally, if you look at any time when the economy goes into recession and markets are under pressure, bonds are a safe haven and tend to do very well. So you can go back in time. So, the past is your friend. There's lots of evidence of it. So we just think that protection would help investors.
Again, why do you think the economy is going into recession? Because all the signals we're getting from the United States are precisely the opposite. You've got the lowest unemployment ever. They've actually, the Americans, unusually for them, have extended this morning. They've made it automatic for immigrants to get their visas increased by another year and a half because they're trying to feed this shortage in the labor market. So where does the recessionary idea come from?
I think it's just what the world economy is going through. You look at the supply chain disruptions, you look at the geopolitical circumstances, you look at inflationary across the board. Consumers can only spend a certain amount of disposable income. So when they have less disposable income, that puts pressure. And I think to some extent, we're not banging the table there's a recession around the corner, but we are saying the risks have certainly increased. We're almost in, like a sour spot kind of moment as opposed to a sweet spot where you have, supply disruptions, inflationary concerns, rising interest rates, less consumable spends. Generally, that kind of cycle often leads to a recession.
It is an interesting point because there are the contrarians, I guess, who would be saying, hang on a minute, you've got so much money that's been thrown into this system. You've got a highly politicized interest rate environment. Will they push interest rates too far or far enough to put the global economy into a recession? But then you see what's happening in China, for instance. And as you say, supply chains. There's so many moving parts. So getting back to the question I had before, what do you do about this, David? Do you invest and just close your eyes and say, I'll come and look again in a year's time?
You got to invest on your principles. There's not one right way of investing or a wrong way of investing. Everyone has their playbook. You play to where you think your strengths are. At Corion, we think valuations, if you stick to your principles and take a long-term view and see where asset prices are pricing relative to history and relative to the environment, take a long-term view, those decisions over time will pay off. They have paid off in the past, and you stick to those principles, it will pay off in the future. So that's the reason why we weren't buying tech, why we weren't overweight the NASDAQ, why we haven't ever been invested in Bitcoin or advised Bitcoin. And Bitcoin's probably a different play because we don't really understand it. You play in your strengths and where you think you've got an edge. Our edge is in that. But if you stick to your investment principles and you think that those principles have worked in the past and are likely to work in the future, that's how we invest.
And you get paid for actually having grit, don't you, in investment markets? Because when you get the volatility and if you chase everybody else in or out, that's when you get punished. But if you can just stay with it over the longer term, you tend to come out on top.
Correct. The short term in investments, 1, 2, 3 months, to us that's pretty meaningless. You've got to take a longer term view. And if you've got the size of assets where you can be nimble and agile and take advantage of this volatility, we should embrace volatility. It's very hard to endure, as I said earlier, over the short term, but that's how you build long-term track records.
I like that. I think Adrian Gore once said, we embrace complexity. We don't say it's easy, of course, but we embrace it in the same way as you embrace volatility. Before we finish,
Correct.
You mentioned the only asset class that did well in April was the US dollar. We know the rand was down almost double digits. Yeah. How did the rand compare with other currencies?
So the rand did worse, to answer that question directly, and there were a few reasons why. We think the floods had a big impact. Eskom was another big impact. But in addition to that, the rand is probably the most liquid emerging market currency. So when there's a flight to safety, the rand generally gets hurt the most. It's a nice proxy for risk in the world. So you add those three things together, you got a rand that depreciated probably more than most emerging market currencies.
I guess it also wasn't helped by the fact that the commodity cycle, at least temporarily, does seem to have now turned the wrong way for this country.
100%. That's a very valid point. Probably an omission that with those other factors was the reason why the rand probably depreciated a little bit more than most.
So to summarize, Corion has got some bonds in the portfolio for a change. How else does your portfolio look going into this very volatile period that we've come out of, and hopefully won't be continuing too badly into the future?
So we've got, for the first time, as you said, global bonds. We've been overweight local bonds for some time because of the commodity cycle, because of, in our opinion, you're getting rates that are attractive for the risk you're taking. We have for some time been slightly overweight South African equities relative to offshore equities.
Which was a very good thing.
Which was a good thing. So our clients fortunately benefited. And I think that's going to probably stay more or less the same. But as I said earlier, we have been slightly buying into this the sell-off, and will be largely overweight risk assets.